exactly right. I think that's
Yeah.
exactly right. Both my wife and my wife's mother too, both very old.
Wow. That is one to definitely hope for, you know. Um,
1 in 6,000 people turn 100. I looked it up the statistic. So
wow.
that's the odds. Small.
Yeah. She's just been obviously living, a great life. That's the bottom
Yep,
line of it.
yep,
Yeah,
that's
yeah,
it.
yeah.
That's exactly right.
Was she born in America, Richard?
Yep, yep, yep.
Right, okay.
Born
Mhm.
Italian immigrant parents.
Okay.
Grandparents came here 120 years ago.
Right, fantastic.
Yeah,
And where was that from, Richard?
Northern Italy. We're
Northern
all
Italy.
from.
I thought it might be with a Rediglia, but
Yeah,
obviously it's your mum you were talking about, so
yes,
I wasn't sure. So it could have, yeah, obviously,
all
but
the
she
same.
came down the same line. Brilliant.
Ding,
So
ding,
yeah,
ding,
because
ding, ding,
we
ding, ding,
are, here
ding,
we are.
ding, ding. That is the bell that rings at 10:30 UAE time every morning and gets me on to be alert with all of the social security benefactors at this table. We Although, if Labour have their way, I think won't be retiring for another 10 years, James. I think they take the heating away and then they push it out 10 years.
Yeah, there you go.
Anyway, the crack at the moment is that Brent crude oil is up over 1% today, but still struggling to get its head above $75 a barrel on Brent, just short of that, 74.72. Let's kick off this morning with Mark Otswald, Chief Economist and Global Strategist at ADM Investor Services International. Mark, I want to kick off this morning with your views on the sort of, have we finally seen a massive stimulus from China this morning or in earlier trade in China today? Interest rate cuts, softening of banking restrictions, lending people money so they can buy equities. Your thoughts on China's stimulus? Little bit too little, too late, or is it going to do some sort of trick to the oil markets?
Well, I think put it this way, it's not shock and awe. That's to sum it up briefly. Um, these are important measures, but at the end of the day, really, if you have a look at all the lending metrics that we've got in China, particularly um, the aggregate social financing and new yuan loans, really what all you can see is despite all the measures that they've taken over the past 2 years, there's just no demand. Indeed, outstanding mortgages are actually falling in China. And if you look at the 200 odd billion of stimulus packages for the housing markets exercised over the past 2 years, there's been an 8% take up. That's a lack of demand and lack of confidence. To me, really, the solution always is going to have to be something along the lines of what happened in late 1980s, early 1990s in the US when they had the savings and loan crisis due to mortgages. Uh, some sort of rec solution which ring fences all the debts associated with property developers and the housing markets. And without that, all these other measures really just aren't going to stimulate it, particularly in a situation where youth unemployment is rising, and wages are falling. And that sort of explains why the consumption in China is actually so weak.
Let's welcome back to the table. It's been a while, Richard Redoglia. How are you, Richard? Nice to see you.
Hi, Sean. Thank you. Nice to see you.
Welcome back. And Richard, of course, CEO of Matrix Global Holdings. We've heard there a bit about the China. I mean, I thought it was interesting today on the Bloomberg reporting in particular. They gave the China announcement all sorts of metaphors and bazookas and blitzing and stimulus and so forth. And a similar 0.5% cut by the Fed last week was sort of in the as expected box, a sort of generic, little bit of a buzz, but generic as expected. The bazooka in China, but kind of as expected in China, in the US, who are so used to stimulus and being bailed out. It seems it's just normal now. But your thoughts on the US outlook, because I think to me that's a bigger question. But we seem to be all pretty clear about what's happening in China. But what's happening in the US, a 50 basis point cut, and yet full employment, yet equity markets banging their heads on the ceiling for months. How do you read that? What does it tell us? And they're announcing even maybe more to come.
A good question. I think the 50 basis point cut was really a function of the anticipation, right? We were supposed to have 6 or 3 or 4 or 5 25 basis cuts by this point, right? I mean, you and I had talked about this going back to the beginning of the year. This is going to be the year of the cuts, and I think what we saw was inflation continuing to raise its head, and I think it's, in a way, it's still there. So really, what we've seen was just a catch up. Right, I think it was just a catch up from what we were expecting so long ago. This is interesting from a political perspective. This is one of the first rate cuts that we've seen in an election year. Almost kind of a rule of thumb is you don't make any large Fed moves within 2 months of an election. And in this
you don't
year,
appoint Supreme Court justices within what, 10 or 12 months or something.
That's
we won't go down that rabbit hole.
I tried. We'll get into that in a second. But yes, that is true. You don't do that either, but that is the case. So I think
that's the McConnell rule, another mad Paddy.
That is really, so is it politics, right? So you brought it up and I didn't, so I'll take the bait there. I'm taking the bait. I think it's a political
Don't
play.
start talking about eating dogs in Ohio. That's where I draw my line.
Again, I'm trying to be good here. Look at this. James, Mark, I'm making a note here. I said nothing to start this off, and it was Sean in the beginning. So yes, yes, I think it was a political play, to be honest with you. I think that's why they needed to do it. There's no way we should be cutting rates at 50 basis points with inflation with the market at all-time highs and unemployment here. It's just, I think we're going to see inflation come back into the housing market again. So we're going to find out. But when you run you run $1 trillion deficit every 100 days, and you start to see your debt continue to build up, interest rates have only really one place to go, is down, because if they go up, you can't pay the interest on your debt. So I think it's a way for rates to go lower, and they did it. And then, is it political? Well, I would tend to think, I wasn't going to say it, but I will think now, it had a political tinge to it, and that's really the goal. The goal is to keep out the big bad orange man, and this is maybe one way to do it, to make people feel that the economy is doing great and everything is hunky dory, and let's just get on and get that new person in there. That, oh, wait a second, it was Biden. Oh no, he's no longer there. It's that other person that's going to come in and be the new president. So, but I think that's really the key. It was a boost.
James McCallum, CEO and chairman of Exergy Group and professor of energy at Strathclyde University. James, having heard the sort of two poles of the world there, China outlook, US outlook, where does that leave, do you think, the oil industry, the supply side? Are you and your peer group or your former peer group going to start putting money in the ground now, or not? Is there confidence there for investment in new supply? Where do you think all of this lands, all this rate cutting lands? Cheaper money, oil industry like that?
Yeah, look, I mean, in a normal market, the oil industry does like cheaper money, and specifically the service sector likes cheaper money. I'll come to answering that specifically in a second, but I just wanted to pick up on something that relates to the point that Mark was making about the housing market in China, but kind of lift up above that. I mean, clearly we also saw in the digest today, sort of like a huge uptick in oil moving into China from Russia, Venezuela, Iran through August, and although not quite up to last August's numbers in terms of imports, very significantly up on the summer imports in China. So clearly, the administration, one would have to think, are anticipating some kind of an uptick in manufacturing production there. And if you're going to anticipate an uptick in manufacturing production, and then you follow that with an interest rate cut, et cetera, clearly domestic demand for product is anticipated to rise. So I just kind of put that out there as a thought for everybody to just keep in the back of their mind. On where we're going with supply. Look, supply has been very stable for a very long period here. It is all, the story of oil price is all around where's demand going to go? If you take a look at the US markets, one could focus on the negative side, which would be the service sector. If you take, I normally comment at this, but if you look at the sort of like the share prices of Schlumberger, Baker Hughes, Halliburton, well down on where they were a year ago. If you take a look at the US shale oil production, very strong. So how are those two things equating against each other? And it's the point which I've been making for a long time, Sean, which is technology, oil and gas technology, service company technology is proving the key to that. There are more wells being drilled, on the drilling pads. The efficiency in terms of the speed of those wells is much faster. And indeed, the horizontal production sections there are getting much longer. So the merged producers are able to produce more from less wells with less rigs. And so the production stays up, but the service companies continue to suffer. And there doesn't seem to be any change in that profile. If you take a look at the super majors oil prices and you look over the course of last year, they're down on a year. But if you look over the longer term, which was something that we were talking about just before we came on air, if you take the longer term picture, the Exxons, the Chevrons, the Shells, the Totals of this world are all at almost peak share prices. So they've got plenty of money in the coffers to do something. They're just not doing it yet. And I think that answers your question, which is that if the super majors are not putting the money into the ground yet, there isn't a confidence yet in where that demand is going to come from. So it's today's session in terms of where price is going, where the markets are going, is another one of those we're all continuing to sit on the fence.
Mark, looking at the sort of narrative of the last 2 weeks or so, the Tuesday, which is 2 weeks ago now, of APEC week, we had Brent open below 70. It was the first time in a number of years. It's since recovered. What's your reading on that window? Very much glass half empty, bare kind of sentiment at the beginning of the month coming out of the summer. Now looking like the glass half full might be getting some traction. At least that's my narrative. Geopolitics is back very strong in the headlines. Big numbers coming out of China on August, imports, etc. Is there a sentiment shift moving in the market here? Your thoughts on that? Is it warranted?
I think the market's actually much more fickle and fluid. I think one of the things I always find interesting in the oil market is to speak to the derivatives traders on the one side and the physical people on the other. And a lot of the time when you get some of these movements, the physical people are going, what are you doing? Why are you moving the price around like this? There's nothing happening. Nothing's really changed. And derivatives traders get all excited by the macro news. So we fly around. There's a bit of volatility, but essentially, I think still people are concerned about the demand outlook. Occasionally we get this confluence, as we have at the moment, of tensions rising in the Middle East and concerns about another supply shock. You've got Libya also on that particular agenda, and then these hopes for China. Now, all I can say, I hope I made it clear enough in answer to the first question. Our hopes for China, it's because China has been the biggest demand driver of oil for the past 30 years that we always hope that this is going to be the magic moment. But I think it's more hopium than anything else, to be very, very honest.
Although the numbers were real in August, right? I mean, we're talking 12 million barrels of imports into China. That's serious numbers. I mean, when you add their own domestic production, that keeps it all above 15. Not
True.
Consumption, perhaps, but nonetheless, 12 million imports is happy days in the Middle East.
Yeah, but on the other side of the coin, when one looks at China's commodity and energy consumption in terms of its imports and exports, it's always price driven rather than demand driven, i.e., basically they always like to buy cheap and then rein in their horns when things pick up. And you've seen it this year with whether it's with iron ore, whether it's with aluminium, whether it's with oil, it's always the same old story. And my concern also would be that you're also seeing in the same set of numbers, a lot of weakness in exports of refined products from China, which suggests that they may be stocking up because that's what they do. But the one of the strongest areas that they've had, which has been strong export demands, is tailing off, and that's probably to a large extent due to the weakness in Europe, where you're also
Yes.
seeing a huge build-up in refined products.
Richard, this is the year, I mean, of many things, but perhaps none more than artificial intelligence and the bionic company in NVIDIA and the maker of chips for AI processing. But the sort of that knocks into the sort of most amazing story of the last few days that I've come across, and this is the news of the restarting of the 3 Mile Island nuclear power plant in an agreement between Constellation Energy and Microsoft. Your thoughts on that as a just a deal and a story of its own?
Remarkable. Yep.
Where is it leading to? I mean, that scale of power requirement, energy demand on a massive scale.
Yeah, I agree with you, Sean. It's a remarkable situation to have that, and I think in a way it puts us back into this historical perspective of these energy markets. And maybe AI is going to be one of the great balancing aspects of what we're going to be experiencing here going in the future. I've said this to you for a while now, and I think it's true. Information technology has allowed for people to understand supply demand in real time. They understand to make decisions quicker. James just talked about how drilling's become more efficient. I just went back to some calculations. Do you know what the price was for oil in 2024 dollars in 1985? It was $70.50. You know what the price of WTI was today? $70.50. You know what the price of oil was 3 years ago? $70.50. Do you know what OPEC was doing in 1985? Saudi was trying to adjust their production to keep the price in a certain band. What's Saudi doing now? They're keeping the price in a certain band. So are we just going round and we're not just, we are going round and round and round. So I find it fascinating. And maybe what your point is well taken, Sean. Maybe this new technology, and this is going to be, I think, where maybe these discussions should go, is how are we going to deal with this surge in energy? Are solar plants and wind plants and quadrupling all this? Are they going to be able to keep up the demand that's going to be demanded by a chat GPT question? I don't think so. And I think what we see is a realization by both politicians and even someone like Bill Gates, who I think he's more concerned about the Microsoft share than maybe what he thinks the climate change is going to be. But they need power, and that is what they need, power, and they need power now. And for 3 Mile Island to come on after being, it was the focal point in the U.S. for stopping nuclear power, really stopped us dead in our tracks. And we're seeing to this day nuclear plants being retired all across the United States. But I find that perspective about oil price, what I just said, to me is just totally fascinating. We're at the same price we were having the same discussions 45 years ago about the same thing. And I think,
well, you might have been having them. Just speak for yourself now. Don't include that royal we.
We're seeing the same thing. So I think the question really, and I think this is something for this forum, is really discussed, is how are we going to meet this demand? Because if 3 Mile is it the tail wagging the dog? Is that what's going to happen now? Because we're going to need a lot more 3 Mile Islands to look for the power that's going to be needed for this new AI revolution.
James, just picking up on that same point. I mean, the year that's in it, the AI surge, in all of its relevant equities, the electrification of everything, and yet oil markets are not moving, not enjoying any of that upswing. I mean, if energy, like the data related to the consumption requirements to meet anything remotely near the AI need, data farms and so on, is just times 10, times 100x. And yet oil markets not seeing any uplift of that this year. Your thoughts on those intersection points?
Yeah, so look, I think the story about the 3 Mile Island power plant is indeed the standout story of the Press Digest of the last 2 to 3 days, and it's an incredibly important story, Sean, because we're now beginning to truly understand the energy consumption that will come with this, if you like, revolution or evolution of the tech environment. And simply, when you understand, of course, that in order for AI to function, it is pulling enormous amounts of data from the cloud to enable it to do its little chat GPT or whatever AI actually progressively moves into. So that energy consumption is not going to go away. What Richard focuses in on, and I think ultimately we will all need to acknowledge is that where we're going to need to go is all of the above. Yeah, and the politicians are beginning to change the rhetoric. Certainly in Europe, we're beginning to hear a sort of a softening of the entirely green agenda back towards, well, how are we going to deal with this energy security issue? Because that's what it will come down to. It's going to be an energy security issue. And that's why I think we're going to need hydrocarbons in the mix. We're going to need renewables in the mix. And what we are seeing today is the re-emergence, if you like, of nuclear in the mix. And in many ways,
nuclear in the mix for Microsoft. I mean, what about the rest of us? I mean, one customer for one nuclear power plant?
Yeah, but doesn't that just tell you? I mean, right. Microsoft, obviously one of the major AI companies in the world, but only one of the major AI companies in the world. And what they're basically saying, the story as it's put out there is we're going to the Three Mile Island nuclear plant because we want low carbon electricity. But they've not gone to the re-emerge with a gas plant. So they're playing the storyline of we want low carbon electricity, which is fine. But back to Richard's point, looking to the disruptive space of solar and wind, which I am a fan of, as you know, won't cut it. The story of a couple of weeks ago, if you like, was a major tech outage when software came down and shut down the airports in the world and flights, et cetera, et cetera. The tech world can't shut down in the space of AI. It can't shut down in the space of how it actually functions. And so it needs a regular, steady stream of electrical supply. We have been used to living with that coming from a hydrocarbon space. Going forward, nuclear will have to play a significant part of that equation.
Let's go to the survey question and get some thoughts on the discussion. China unleashed stimulus blitz today to stimulate economy. Will it ignite oil markets? China unleashed stimulus blitz today to stimulate. There's a lot of stimulate in that sentence, but nonetheless, you get the story. Yes, no, little impact. Mark, just looking forward, we're coming up to the sort of tail end of the third quarter, coming out of the summer and the sort of turbulence of the equity markets and all had a wobble. And now we're on the back of this significant rate cut in the US, rate cut in Europe, and generally in an easing cycle. Where does that point, you think, for the direction of travel in the fourth quarter for the oil markets?
Well, I think what we have a problem now is valuations. And in that sense, the equity markets look very overbought, and most of the commodity space, including oil, actually looks quite cheap. The point that Richard and James made about where we go with AI, I think my biggest question is AI actually going to save us money? Because I think in the long run, it's energy demand and also the move to the energy transition, which is a more expensive form of energy, and we're way off bringing it down to the sort of level of hydrocarbons as yet. The technology just hasn't got there. So I think for oil markets, the two factors is if the Fed accelerates rate cuts, it's going to be, it will weaken the dollar to some extent, and that's a general positive for commodity markets. It's not as closely aligned as people think.
I mean, on the question of the weakening, Mark, your thoughts? I mean, I'm still trying to understand. Obviously, Richard indicated some political games playing, but is the Fed in search of the new neutral rate level? I mean, these are big cuts that usually indicate economic weakness, but apparently on this occasion not.
Well, that's exactly where we've got this dichotomy, which is going to create volatility over the rest of the year. because on the one hand, markets basically, the Fed's taken out the insurance 50 basis points and is not talking about being aggressive going forward. So markets can basically hang on to this Goldilocks soft landing scenario. But on the other hand, if we basically see a sharper rise in unemployment in the US, then they'll probably be more aggressive. And at that point, markets then have to look at particularly equity markets have to look at their valuations. And, the oil market is going to be subject to this fluctuation on, we'll always have China in the background, and we should also focus on India, I would add, and indeed Brazil. But it's going to be this question about the daddy in the room, which is always the US economy, and what the outlook for the US economy is. My only thing with the US is everyone's been predicting a recession now for 2 years. I'm almost bored to tears of listening to people. There is a fiscal cliff looming in terms of all the things related to the Inflation Reduction Act and indeed the CHIPS Act, and that's probably going to actually tell us a lot of what happens to those post-election is probably going to be the decider on what happens to the US economy and indeed to people's views on oil demand.
I asked a question at the FT Summit in Lausanne earlier this year, which was, will the G7 West ever see a recession again? And I was laughed at, and I was perfectly serious because it just doesn't seem like it's permitted by monetary policymakers or fiscal. Richard, I wanted to get your insight into this drama that's been going on in the financial management, the financial interest in the oil markets. We saw for the first time ever a net short position over longs for the first time, and then earlier this month that coincided with that close below $70 on Brent. Your thoughts on what the technical mechanics of that unwinding or not unwinding and how it plays into the direction of the market?
Good question. One of the things I think we're seeing is what's happening to Cushing storage, right? Cushing storage is where WTI is priced, and I think we need to start tracking things like the Cushing to Magellan East Houston pricing, because now WTI, which I think we should all be proud of, and shows you how efficient oil markets are. WTI is one of the major deliverable crudes into Brent, right? And so, did we really see what was just basically the kind of the regurgitating of all longs? Okay, the world's going down, get rid of all length, and down it goes. Well, you get oil stocks down to 25 million barrels in Cushing, Oklahoma, and you are at tank bottoms. There's no more room to go. So it lends itself to almost just a fundamental support, right? A fundamental support in the marketplace. And I'm just thinking that's what we're going to have to keep an eye on. To me, that's one of the most bullish things out there is basically low crude stocks. Now, most of the crude doesn't go through Cushing because a Cushing barrel cannot be delivered into the Brent complex. Right, it has to come from the Permian, and or Corpus Christi. So I think there's this mix-up, and I think maybe Marcus said it earlier. There's a battle between the fundamental guys and the derivative guys, and I think we just saw the derivative guys cough it up. It's going down. Let's be bearish. I think it's going to get to a point where they're going to say, you know what, the risk return here is not in my favor from a fundamental perspective, and that's where I think some of the length will come from. It'll come from this kind of fundamental, I'd rather be long given these crude stocks in the United States if I'm going to be playing WTI. I think that's kind of the general sense I would get. Also another factor, there are two pipelines that are coming online from Permian. Two natural gas pipelines have been flared. They've been flaring natural gas for a while, and two new pipelines are coming on. So natural gas that was being flared, and we're gonna have to see what that's going to do with the production level. So it's gonna be an interesting battle of where this is going to come out. But I tend to think it's a little more bullish, only from a fundamental supply inventory perspective.
James, last word to you. I wanted to get your insights on a subject I know you follow. Well, we got a little impact here, most in this room. Let's see if that concurs on social media. Your thoughts on the news also this week, which I think is noteworthy, and that's the shift to the right. Big results in the AfD, again in Germany, stacking up to what appears that is going to be a very interesting election there next year. Why the UK did move to the left, or whatever Keir Starmer is. left of Tilda Hun. I'm not sure, but the government that we saw our Macron put together in France, very right of centre, even though the left did pretty much win that election from a singular bloc point of view. But just generally your thoughts, because it all plays into where could Ukraine go as we shift heavily to the right in Europe? Your thoughts on that?
Yeah, I mean, whether we're shifting heavily or whether it's a sort of a spike reaction to continued unhappiness. Look, politics in a social media context is continually defined by the emotion of the central populace, and when they don't think they're being listened to, we're seeing that reaction flash out, and you can take that right back. Obviously, I will look at it from a European perspective, whether that's a vote on Scottish independence on a very, very insular level, or Brexit on a national level, or what's going on in Europe. The shift to the right is the angry vote. Whether, and I know Richard and I are very different on this. What happens in American politics has for the last decade been very much in this reactionary vote. How does that shape the whole of the shift in national agenda? We're continuing to see in Central Europe a destabilization that's resulting in a populist vote towards the far right. And until we actually see some real results around issues which people are really, really bothered about, which is how far the money in their pocket is going, the continued ingress of people from circumstances far less fortunate than all of us enjoy in the countries that we live in, but won't go away until we see those kind of things settle back into a centrist place, whether it's centre left or centre right. I think we'll continue to see these things. But for me, I like to live in the hope that these are flash events and not a trend.
Yeah, well, it seems to be that the trend is setting in the sense that, obviously it's been progressive over some time now. The result in Holland, which is, I think, more than a year ago, Le Pen at the European elections, and now the move in Germany to the et cetera, et cetera. We're all relying on Poland, Mark. Come on, hold the line.
We're in the centre.
We're in the center
in Poland.
Mr. Tusk, my new favorite guy. Hopefully he holds the line there. Thank you, everybody. Really great to have you back at the table. I'm not sure if we'll see you all in Fujairah on the 1st and 2nd of October, but I hope we do. James McCallum, CEO and Chairman of Exergy Group, Richard Adoglia, CEO of Matrix Global Holdings, and Mark Oswald, Chief Economist and Global Strategist at the ADM Investor Services International. Thank you for coming back to this table, and look forward to seeing you all again soon. Take care.
Sean. Thanks,
Thank you, Sean. Gentlemen, good to see you. Bye-bye.
Take care. Bye-bye.
Bye.